Money. It's something most of us think about every day, but what if it's not as real as we've been led to believe? In fact, over 80% of the world's money exists digitally, in the form of bank deposits and electronic transactions, yet it's not backed by any tangible asset. Did you know that since 1971, the US dollar has lost 85% of its purchasing power due to inflation? This means that money, the very thing we rely on, is actually disappearing. Most of us chase after wealth, thinking it will bring happiness and security. But what if the system is designed to keep us chasing an illusion? In this video, we're going to uncover how money plays a trick on us, and how most people are investing in the wrong things. We'll look at the true power of capital, why market prices don't always match reality, and how you can invest for long-term value instead of chasing quick, empty wins. Stay with us, because the truth about money might just change the way you look at everything. Chapter 1. The Mirage of Modern Wealth. How we've been chasing the wrong horizon in today's world. Wealth is often portrayed as an unattainable dream. But what if that dream is an illusion? We're constantly bombarded with images of success, luxury cars, big houses, designer clothes, so much so that we forget what real wealth looks like. The modern obsession with instant gratification has distorted how we think about money. In reality, wealth isn't just about flashy things, it's about having a stable, secure future. The problem with society's current view of wealth is that it focuses on external markers rather than true value. Many people chase high-paying jobs or invest in trendy stocks simply because they look good. But, in the long run, these pursuits don't necessarily lead to real prosperity. In fact, studies show that most high-income earners live paycheck to paycheck, always one misstep away from financial disaster. Meanwhile, value investors like Warren Buffett focus on the intrinsic value of businesses, not just their price tags. The key to moving past this illusion is understanding that wealth doesn't always come quickly. Buffett's success wasn't built overnight, it took decades of smart, long-term decisions. As Buffett once said, the stock market is a device for transferring money from the impatient to the patient. Patience is central to value investing. Real wealth is built through steady growth, not by chasing the next hot investment or quick fix. Look at the numbers. Research by Credit Suisse shows that the wealthiest individuals often have their assets tied to real estate or long-term stock investments. They don't follow trends. They buy undervalued assets and hold them for the long term, allowing time to unlock their true value. This strategy not only combats the fleeting nature of fads, but it also provides a stable foundation for future financial security. Value investing is about understanding the difference between what you want and what you need. Chasing superficial wealth can lead to disappointment, while focusing on intrinsic value offers a clearer path forward. Instead of buying the latest tech gadget or luxury item, consider investing in something that will grow in value over time, like stocks in a well-established company or rental properties in a growing market. It's easy to get distracted by the quick wins that seem to come with the latest trends. But if you take a step back and focus on the bigger picture, you'll see that true wealth is more about stability and long-term growth than about flaunting your success. Shift your focus from the illusion of quick wealth to the reality of long-term investing. When you start making investments with patience and foresight, you'll be on the path to achieving genuine wealth. Chapter 2. Value versus vanity. Decoding the true cost of financial illusions. When you look at today's market, it's easy to get caught up in the allure of high-flying stocks and flashy startups. But there's a stark difference between investing for real value and chasing after vanity investments that look good on paper but lack substance. Many people fall for vanity, putting their money into what's popular instead of what's actually profitable. This trend has been going on for decades. Take the dot-com bubble in the late 90s, for example. People threw money into tech stocks because they thought the internet was the future, but most of those companies had little to no profits or long-term plans. According to Investopedia, nearly 80% of the companies that went public during the dot-com bubble ended up failing. Vanity investing can be a dangerous game because it's often driven by emotions, not rational thought. The true cost of vanity investments is something many don't realize until it's too late. They might see their portfolio jump in value, but the highs are usually followed by crushing lows. To avoid this, value investors look for companies with strong fundamentals, steady revenue, a solid business model, and competent management. When you focus on these factors, you're less likely to fall victim to short-term market whims. Take a look at Coca-Cola, a company Warren Buffett has long invested in. Buffett has often spoken about the importance of buying businesses with a moat, or a sustainable competitive advantage. Coca-Cola has one of the most recognized brands in the world, and it has continually outperformed the market over the long term. This is the difference between vanity and value. Vanity might offer a quick boost, but value investing provides long-term stability. Even in today's tech-driven world, the fundamentals haven't changed. Look at Apple. Its value isn't based on the latest flashy product release, but on its consistent ability to innovate and maintain strong customer loyalty. This is the essence of value investing. Finding businesses that not only look good but also have the strength to last. By focusing on real value, you can avoid the temptations of vanity investing. The key is to stop thinking in terms of quick wins and start thinking about the long-term potential of your investments. Take your time, do the research, and invest in companies that have real growth prospects, not just in the hype of the moment. Chapter 3. The Great Deception. How inflation makes money disappear. Inflation is often seen as a background noise to financial conversations, but its effects are far more insidious than most realize. Over time, inflation erodes the value of money, quietly and steadily diminishing your purchasing power. For example, $1 in 1950 would be worth about $11 today due to inflation, according to the U.S. Bureau of Labor Statistics. That's a loss of 90% of its original purchasing power. This is the Great Deception. People think their cash will hold its value forever, but inflation proves otherwise. When you hold on to cash, you're not just saving, it's losing value every year. In fact, the average inflation rate in the US has been around 3% annually over the last 100 years. It doesn't sound like much, but when compounded over time, it can have a major impact on your wealth. For value investors, this is a huge opportunity to make smart moves. Instead of leaving your money in low-interest savings accounts or under your mattress, consider investing in assets that tend to outpace inflation. Historically, stocks and real estate have been two of the most reliable ways to do this. According to historical data from Credit Suisse, the global stock market has returned an average of 7–8% per year over the past century, far outpacing inflation. One of the main strategies used by value investors to combat inflation is investing in businesses that have the ability to raise prices in line with inflation. Companies with strong pricing power, like those in consumer goods or healthcare, can continue to generate profits even as inflation rises. Take Procter & Gamble, for example. This company has been able to consistently raise prices on its products, which helps it maintain profit margins even as inflation increases. Another strategy is to focus on real estate, which historically has been a great hedge against inflation. Real estate values tend to rise over time, and rental properties can generate consistent income. As prices go up, so do rents, making it a win-win for investors who understand the long-term benefits. The key takeaway here is that inflation isn't just a background issue, it's a critical factor in how you manage your wealth. By investing in assets that can outpace inflation, like stocks, real estate, or businesses with pricing power, you can preserve and even grow your wealth over time. Just remember, if you keep your money in cash, you're slowly watching it disappear. If you're enjoying the content so far, make sure to hit the subscribe button so you don't miss the next chapters. Chapter 4. The Price Tag Paradox. Why market prices don't always reflect reality. If you've ever watched the stock market rise and fall, you've probably noticed that prices don't always make sense. Sometimes, the market overreacts to good news, driving prices up, while other times it panics over bad news and drops them. This is where the price tag paradox comes into play. The price of an asset doesn't always reflect its true value. Consider the example of the housing market in 2008. Prices were inflated due to a combination of speculation and poor lending practices, making homes appear worth more than they actually were. As a result, when the bubble burst, millions of people lost everything. A similar trend can happen in the stock market, where excitement or fear can cause prices to skyrocket or plummet, leaving true value in the dust. To understand this paradox, you need to look beyond the price tag and focus on intrinsic value. Intrinsic value is what an asset is really worth, based on its fundamentals like earnings, growth potential, and competitive advantages. Warren Buffett once said, "Price is what you pay, value is what you get. It's an essential principle of value investing. You can only make wise decisions by understanding the true worth of an asset, not just its price. One strategy value investors use to measure intrinsic value is discounted cash flow, DCF, analysis. DCF involves estimating the future cash flows a company will generate and then adjusting them for the time value of money. This helps investors see past temporary market swings and get a clearer picture of a company's long-term value. By using this method, investors can spot undervalued stocks that the market has overlooked. Another important factor in understanding price versus value is market sentiment. Often, the market gets swept up in a herd mentality, buying into a stock or asset simply because others are doing the same. In these cases, the price can be far removed from what the asset is truly worth. As the famous investor John Templeton put it, the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. So, how can you take advantage of this paradox? First, you need to develop the ability to ignore short-term market noise. Focus on the fundamentals of a business or asset. Is it profitable? Does it have a competitive edge? Can it grow over time? When you start making decisions based on these factors rather than the daily price changes, you'll find more opportunities to invest in real value. Chapter 5. The real power of capital. Investing in what doesn't fade. When it comes to investing, many people focus on tangible assets like stocks, bonds, or real estate. But there's another kind of capital that's even more powerful: intangible assets. Things like knowledge, skills, and relationships often hold the most value, even though they're not as easily measured. Take, for example, the rise of tech companies like Google and Amazon. These businesses are built on intellectual capital, the knowledge and creativity of their founders and teams. Unlike physical assets, intellectual capital doesn't wear out or depreciate over time. Instead, it has the potential to grow exponentially. As Jeff Bezos famously said, "Your brand is what other people say about you when you're not in the room." The power of intellectual capital is in the reputation and trust built over years. Similarly, investing in education and skills can be one of the best decisions you make. According to the U.S. Bureau of Labor Statistics, those with a bachelor's degree earn, on average, about 65% more than those with just a high school diploma. In other words, the returns on investing in your own knowledge are significant, and unlike other investments, the value only increases as you grow. But it's not just about investing in yourself. Building strong, meaningful relationships is another form of intangible capital. Networking, mentoring, and partnerships often lead to valuable opportunities that can't be found on a balance sheet. For instance, Mark Zuckerberg's success wasn't just due to his technical skills, but also the relationships he built with early Facebook investors and collaborators. A key to understanding the power of intangible capital is realizing that it's not about instant returns. You might not see the payoff from investing in education or relationships right away, but over time, the value compounds. This is a concept known as the compound effect, popularized by Darren Hardy. It's the idea that small, consistent investments, whether in knowledge or relationships, lead to massive long-term rewards. The takeaway here is that while tangible investments like stocks and real estate are important, they shouldn't be the only focus. Investing in things that don't fade, like knowledge, skills, and relationships, can provide you with the greatest returns. These forms of capital build a foundation that is more resilient than any physical asset. Chapter 6. Breaking free from the illusion. Practical steps to start investing in true value. Now that we've discussed the illusions that surround money and investing, it's time to take action. Breaking free from these illusions isn't about jumping into complex strategies. It's about making simple, smart decisions that will pay off over time. Let's explore some practical steps you can take to start investing in true value. First, begin by shifting your mindset. It's important to stop thinking of investing as a quick way to get rich. Instead, focus on building long-term wealth. One of the simplest ways to start is by reading and learning. As Peter Lynch, one of the most successful investors of all time, said, "The person that turns over the most rocks wins the game." And that's always been my philosophy. By consistently learning and staying informed, you'll be better equipped to identify good investment opportunities. Next, take a closer look at the businesses you're investing in. Focus on companies with strong fundamentals, like consistent earnings, a solid business model, and experienced management. A great example of this is Johnson & Johnson, a company that has been consistently profitable for decades. By sticking to companies with proven track records, you'll avoid the temptation to invest in flashy stocks that may not stand the test of time. Consider diversifying your investments. While it's tempting to put all your money into one high-flying stock, true value investing requires balance. A diversified portfolio helps minimize risk and provides the stability needed for long-term growth. It's about spreading your investments across different industries and asset classes to reduce exposure to any single risk. Another key strategy is to be patient. As we've discussed earlier, investing for the long term is the real secret to building wealth. It might take years or even decades for your investments to pay off, but when you invest in true value, the rewards can be massive. Remember, as Warren Buffett advises, the stock market is a device for transferring money from the impatient to the patient. Lastly, always reinvest your profits. Instead of cashing out when your investments grow, keep reinvesting those gains to take full advantage of compounding. This is how wealth is built over time. Even small amounts can grow into significant sums if you stay consistent. By following these practical steps, shifting your mindset, focusing on strong companies, diversifying your portfolio, practicing patience, and reinvesting profits, you can start investing in true value. The key is to look beyond the illusions of instant wealth and focus on sustainable, long-term growth. When you do, you'll be on your way to building real, lasting wealth. Don't forget to subscribe and turn on notifications so you never miss valuable tips for achieving financial freedom.